My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to a very special West Coast Cramerica takeover. Other people want to make friends. I'm just trying to make you some money. My job, not just to entertain, but to educate, teach, put it in context. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. You invent, you disrupt, or you die. That's the mantra of so many businesses out here. The tsunami of invention and disruption reaches far beyond this intense city and the valley that abuts it. The storm clouds darkening the fortunes of others in the inevitable riptide of creative destruction. The reverberations rattle whole industries, with a wake so brutal that they often determine the direction of stock prices in whole segments, or even the market itself. On a day where the Dow dropped 55 points, S&P 500 lost 0.16%, and the Nasdaq decreased 0.24%. Let's just deal with the news, and so you understand the prism. Take the biggest stock news of the day, the possible combination between Schwab and TD Ameritrade, with the former potentially buying the latter in a $26 billion combination that would create what might be an unbeatable $5 trillion online colossus. These two companies have been sworn opponents ever since electronic trading became the way of the future more than 25 years ago. They and E-Trade have been in a battle for assets. I mean, it's been incredible. And assets and commissions, the latter knowing no bounds, with pervasive advertising, fancy trading platforms, and most of all, yes, that's right, the right price to trade. They could charge low commissions versus, say, the commissions I charged when I worked at Goldman Sachs because of their scale. They could literally make it up in volume. Their stocks and that of E-Trade, often mentioned in the same breath, have tended to rise and fall with the gyrations of the stock market. Although, over time, the waning interest by individuals, many of whom have been brainwashed into buying and holding a lot of suboptimal ETFs, has given you a secular decline in the business. Still, profits have been solid, and after three-fronted Verdun-like battle that they've been undergoing, they settled into kind of a profitable moment, with Schwab becoming the premier asset gatherer of our time. Besides being a commission juggernaut, asset gathering being a very profitable business. And then along comes Robinhood, an online startup charging no commissions for stock trading. Why don't you just consider them a perk for giving them your assets? And you know what? Nothing's ever been the same. The company began a half dozen years ago and rapidly took off on the fingers of millennials who actually like stocks. They like to buy and sell them. How fast has it grown? It's about the size of the much more famous E-Trade, more than 4 million accounts. More importantly, they are just the kind of clients you want. Younger, active, enthused, and not beaten down by wise men who tell them it's a fool's game to try to make money. They try and they succeed. Robinhood, that character who robs the rich to provide to the poor. A mythical figure, a constant allegory, and perfect name for a company that robs from the commission-charging overlords and gives to the generation that likes everything for free if it's online. No Wall Street outfit would ever think of robbing for the rich. They are the rich. They like the status quo. Robinhood, founded a stone's throw from the Bureau, at least if you had a Herculean arm, sought to destroy the status quo, as so many companies out here try to do. When you want to invent or when you want to disrupt, as Robinhood does, you have a source of ready cash, venture capital money to the tune of, I'd say, more than $860 million. With that amount of money, you can lose a fortune on no commissions and make it up in volume. Yes, you can do it. Asset volume. As is so often the case, the incumbents didn't see it coming, or they ignored Robinhood, figured it had to go away, right? I mean, with no commissions? I mean, when I meet young people, though, I see them all the time in my travels. You know what they sing the praise of? Something I'd never heard of until it seeped into the young investor's consciousness. Robinhood. Earlier this year, though, Robinhood reached a tipping point in asset gathering that the incumbents like Schwab and TD Ameritrade had to respond by abandoning commissions. Consequently, when that happened, their stocks were crushed. Hence the creative destruction unleashed by Silicon Valley. Now, these companies have to try to combine to cut tech spending. It's so expensive to be a broker now. Ad spending, defend their turf from the highway robbers brimming with happy VCs who don't mind losing money as long as they can cash out in the end. Cash out with high revenue growth and a stock offering not far down the road. It's the same thing with Grubhub, the food delivery company that was the Colossus, roughly $140 stock 14 months ago, before it became clear that the venture capital-backed DoorDash decided to go for revenue growth using its private status to scorch and burn the public competition. The revenue growth that would have gone to Grubhub. No wonder a stock loses $100. With more than $2 billion in VC-provided cash, including $535 million from SoftBank, the once pristine, now ultimately considered brilliant or has been post the WeWork disaster company, DoorDash can and will mow down anyone. The detritus of this unicorn? Well, they include companies, all sorts of companies that find themselves challenged by the cost of delivery versus typical customers. And in some cases, you know what, even the technologically savvy Domino's has been hurt, as DoorDash can mimic an entire delivery ecosystem like the ones Domino's naturally has. All this week, we've been checking in with a number of institutions that use technology to increase their touch with customers, another more hidden disruptive force. We've managed to bob and weave around the 171,000 folks attending Dreamforce, the extravaganza, and, well, that Salesforce throws once a year, and here's something we've come up with. The reason why Tiffany's, another venerable institution, might soon fall into the clutches of LVMH, it's out here. It's out here. I don't know if you've been following this saga, but LVMH, which is the world's largest luxury goods company, doesn't do it all alone. It uses Salesforce to provide a seamless customer experience, whether shopping in-store or online across all of its brands, which is the new omni-channel way that you must have. Now, if you were going to a Louis Vuitton store, Salesforce co-CEO Mark Benioff told me, you might see the sales rep carrying a phone or an iPad with a mobile clienteling app powered by Salesforce, and it's connected to a single customer record to enable a personalized luxury experience. Now, you also may have seen this little Einstein doll on the set when I interviewed Mark. Well, that thing's a symbol for artificial intelligence, helping you figure out what gift you might want. And we do need help when we go to stores and we go online. Now, I bring all this up because as a Tiffany shopper, I have never, ever seen anything even remotely like that in its stores. While I like their goods, I always feel like it is the first time I have ever been to the store, despite the thousands and thousands of dollars I've spent there. I might as well be a three-eyed alien when I'm in there. I think the lack of tech spend at Tiffany is so palpable that LVMH sees it as a gem to be polished as part of its larger stable of brands, and I don't blame them. The company's management probably salivates about what can happen with its Salesforce-powered technology for customer relations management and that Tiffany client list. So let's think about this. Brokerage industry, retail industry, food delivery industry. Well, what are we thinking here? Prospective mergers, disruption, invention, and death. The latter is what happens when you can't figure out how to use technology or won't spend the money. And when that occurs, well, let's just say the entrenched incumbents out there, they either learn it sooner or, unfortunately, later. Let's take some calls. Let's go to Michael in Texas. Michael.
Hey, Jim, good to talk to you.
Same.
My stock is Bristol Myers, and, they merged that Celgene thing there. And I was wondering if you thought it was going to be a doubler right away.
I think it's going to be terrific. As you can see, the stock's up 10 straight points, and it is not done. Dr. Cafario is going to take those merged companies, and you're going to start hearing raise numbers, raise numbers, raise numbers, raise numbers. Buy Bristol Myers, invent, disrupt, die. That's the mantra out here. You got to invent, disrupt, or you will. On Mad Money tonight from CNBC One Market. United was once the black sheep of the airline cohort, but is it clear skies ahead for the company? I've got the CEO. Then while we're out in California for a week, I think it's time to take a moment to talk about the cannabis sector, which has been up in smoke. After all, this stuff has been legal out here for a couple of years now. I'm breaking down the action in the group, and it's a stock up over 100% year to date. But is there still time to get into the stock of AMD? I'm talking with the always bankable CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.